Everyone says you can safely retire with the 4% rule. You heard of it? So I'm going to expose why the 4% rule is a lie and why it's dangerous, especially if you're trying to retire early. It's even more dangerous, and what you should do instead to get real freedom. Tune in now. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You worked so freaking hard for your money, and you're now ready for that money to start working harder for you today. You want that cash flow. You want the freedom. You want to become work optional, where you work because you want to, not because you have to, because you have enough passive income coming in from your money so that you work by choice. You have the control. You get to have the control of the reins in your own life, in your own destiny, in your own time freedom. But more importantly, you're not just doing it to live fat and happy. You're doing it because you know you can bless more lives as you're blessed as well. And that's the ripple effect I'm here to create for you today. Thank you for allowing me to create this ripple effect for you guys for now more than 11 years on this podcast. So thank you for tuning in, sharing this with your friends. And please, so if you haven't done so, do so today. Please share this with a friend, especially if you've had anybody talking about different things that you know are myths. These podcast episodes we're doing are exposing those myths left and right. So be sure to share this with someone you care about today. All right, guys. So I want to talk about this whole 4% rule, right? We've heard about it for so long, right? If you have $1 million, you can pull out 4% a year for the rest of your life. You should never run out of money and all that kind of stuff. Well, guess again, right? Morningstar actually came out with an article recently. In fact, this was actually just the end of last year, 2024. This is, by the way, after the market goes up. The numbers, they do update this every year, but they actually did an article saying, say goodbye to the 4% rule. So what is that 4% rule? What could you do? They say roughly it's like 3.7%, that you have a 90% chance of your money lasting for life, right? There could be exceptions to that. You could live longer, yada, yada. Things could change, but they're saying the 4% rule is not conservative enough. It's got to be maybe 3.7. And I've seen over and over, it's ranged somewhere in the threes at some point or another over the different years. But we're seeing articles like this all the time. You look it up, you could find it. Like, it's everywhere. Now, what's interesting, the guy that came up with the 4% rule, and he created it in the 90s. But the funny thing is, he took the stats from 1926 to 1976 to create this 4% rule. He says, hey, from this period to this period, if you pulled out 4% a year from 1926 to 1976, you didn't run out of money. Even if you're in the market, right? Or depending on how you were invested in the market. What I find fascinating, he actually believes you could pull out more now. He says, oh no, you can actually do 4.7%, right? So the guy that created this, he even says it's not a rule, it's more of a guideline. But he says, as you get older, get more risky. He's like, put more money in equities as you get older. That's the way to make it work. Which I'm just like, that's so stupid. But here's the thing, guys. It's all based on factors, right? One, based on what the market should return, the ups and the downs, what can make it work. Remember, a down year is bad when you're pulling out money, because say you have $1 million and then the market, and you're planning to pull out 4%, that's 40,000 a year, right? The market drops 10%, you're now down to $900,000. You pull out 40,000, you're down to 860. Now, this means that if you want to pull out 40,000 again, and you want to keep it at least, well, you want to get back up to $1 million, right? That's an issue, because now you're at 860,000. So you got to get up to $1,040,000. That means you've got to make almost $200,000. So you have to hope that the next year, after dropping 10%, makes over 20% for you to come back to where you were, right? And that's a little bit risky. That doesn't always work out well, especially as you well know, the S&P has averaged 8.4% the last 30 years, as I've shown you many times, not just here on this podcast, but also on masterclasses I've done on the same YouTube channel. If you're on our YouTube channel, you know. So anyways, that's part of it. So one, they believe that the market will perform the way it's always performed. Two, here's the problem with that 1926, 1976. The reason that's going down is really for two reasons. One, life expectancy, although it's flattened lately, a little bit more down, like it's people have actually they're living 8 months less with the baby boomer generation than they were the previous generation. So it's kind of flattened a little bit. But for the most part, we're seeing the life expectancy going up. It's trending up over the years, right? So people are living longer. And if you keep putting the age at 65 or 62, whatever you think retirement is, guess what? That's more years to pull out money. In addition to that, inflation, as we just addressed recently in the previous episode, I talked about inflation. They're all basing this on the currently reported inflation rates of roughly 2.5%, give or take. So remember, if inflation is higher, you're going to be pulling out more. Pulling out 4% a year does not work long term if you just only pull out 4%, because of course that money becomes worth less and less. You basically go more and more broke because you don't get a raise. So if you want to factor in giving yourself raises and everything else, it's really closer to about a 3% rule, not a 4%. That's the thing, is that again, you got to be so careful. Like people talking about pulling out 4%. Heck, you got guys like Dave Ramsey saying you should be able to pull out 8%, which is even worse. And I did an episode, I think it was last year, where I already addressed that. That was completely false. It's definitely not true. But we did, but that's just ridiculous, right? 4%, although closer, it's not great. Here's the problem though. The 4% rule should work, quote unquote, right? Again, results can vary, but 4% rule should work if you're in your 70s and above. So roughly 70 years old or older and you're retiring, 4% should work. It should last you. But if you're trying to do it in your 60s, especially your early to mid 60s, it's closer to 3%. But what about those of you that want to retire early? What about those of you that follow the FIRE movement, that literally you count on becoming FIRE, which is financially independent, retire early? Many of them are like in their about 40s or younger, that say, well, as long as I can live on 4%, I'm fine. If you have a longer timeline, that number just decreases. It gets down closer to 2% a year. So it's not a 4% rule if you want to retire early, it's 2% rule. But again, everybody just makes this crazy assumption. By the way, I got kicked out of the Facebook group for the FIRE movement because I dropped that little bomb on them. I said, hey, this is just math for one. Two, I'm not the only one. There's our companies like Morningstar out there saying that that's not applicable to early retirees. This is only applicable to mid to late retirees, right? Those that are retiring at least at retirement age. And so they booted me out of the group for speaking truth. Sorry, guys. I can't help myself. So that's the thing, guys. There's so much crap taught out there today. So many people just teaching all these false assumptions. Remember, if you have a false assumption that the stock market average is 12%, and you have the false assumption that the inflation is only 2 or 3%, yeah, you're going to think that 4% should work. But it doesn't. And especially if you're a healthy person. And just so you know, I've known people that were unhealthy that lasted longer. I mean, at the date of this recording right now, my dad just turned 81 years old today at the date of this recording. I mean, he ate, drank, and be married, right? Like that's what he did. Like he basically just ate whatever he wanted. And he's like, it's okay. I'll have a widowmaker heart attack, take me out, and at least I'll die happy. Guess what? Years later, that didn't happen. Modern medicine has kept him alive longer, and then he's had to stretch out his money as long as possible. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. You do not want to end up in this kind of situation because it's happening all of the time right now. Many people, this is now the biggest fear for people, right, is just running out of money. For retirees, that's always the fear, is how do I keep my money lasting? What if I live too long? What's going to happen? And that's not because they didn't save enough. Stop believing those lies from financial pundits that judge you and tell you that you're not doing enough, when in reality, you're doing exactly what they told you to do in the beginning, but they just keep upping the ante. They keep telling you, well, you just got to save more, save more, save more. Well, maybe you didn't do it right. No, maybe your advice sucks, guys. That's maybe why it's not working right. If you actually taught people truth from the beginning, like I'm trying to do here, they wouldn't have this problem, right? They wouldn't be facing a situation with this overpromise, underdeliver, because they thought they'd have all this money in the end, but the market didn't return as well, and then inflation's eating it away, and now they're realizing they can't live on as much anymore, and that they have less years to live on as a result. You work for freaking 40 plus years to then live on maybe 10 or 15 years? That sounds like crap to me, doesn't it to you? So, anyways, that was my rant there. But my point is this is that you need to make sure you're doing what's right. How do you beat this? How do you not do this? The best way to not have to worry about a 3, 4% rule, 2% rule, whatever it is reject that mutual funds are the place to put your money. This is only in place because mutual funds have these ups and downs, right? This highs and lows. Now, most of the time it's going up. They count on that. They count on the statistics. Doesn't mean it will, right? Because there's an article, I can't remember if it was in this one or another one, but there's a financial advisor that said, hey, well, 1994 to 2000, you felt great if you're pulling out money. But then from 2000 to 2015, you weren't feeling great. In fact, you lost money because the markets had some down years. So you're pulling it out and then you've lost a good chunk of your money. And with inflation keep going up, it makes it even harder to live on. And so you got to be very careful. Break away from believing that mutual funds is the only strategy you can do. There's so many more options. This is why I teach what I do with alternative investments, which is or what the wealthy use anyways. We're just teaching you how to do what the wealthy have been doing for years and just apply it for you, even if you're middle to upper class, even if you're lower end of the upper class, whatever you might want to say. I know you may not be a billionaire. If you're a billionaire, you probably don't care about this channel, right? You're people that are obviously, we could be high income earners, people that make a decent amount of money, but you want to know how to make your money work harder for you. So you stop working so hard for it. Well, that's why alternative investments exist. And this is why we focus on income, not so much just how do I stretch out my dollars. This is why we have so many investments that pay 10, 12% a year, and not from like a speculation based on what the market does, but contractually we'll say, hey, we're going to pay you X percent, 10%, 10.5%, 11, 12%, sometimes even more. But they will tell you to do that contractually in some cases. Other times it's just estimations. It could be better. It could be a little worse, right? It's possible you could lose your money. Just so you know, there's risks still involved with alternative investments. That's the whole point of investments. But if you can have more asset-backed investments, investments that aren't based on speculation and high-frequency traders or HFT, which is over 90% of the trades right now. Do you know that the HFT, it's not humans doing the trading in the stock market right now. The whole market you're seeing going up and down is it's all computers, guys. And it's computers that can literally make thousands of trades per second, not per day, per second. Most humans can't even do thousands of trades in a day, right? So it's happening so much faster right now that humans are losing control of it. This is kind of like the people's fear of AI, right? Although I love AI in so many ways, there's a lot of things that people are concerned about because what if it starts to shift? What if something goes cuckoo with it? That could affect us, right? We've already seen little spastic things happen before, like with quick little market crashes. I mean, I remember, I think it was 2008 or 9, they had to close the market because they were testing it. And all of a sudden, like the market dropped like 500 points. They're like, whoa, okay, pause. Okay, that didn't work. Let's open back up again with new stuff. So just so you know, this has been happening for a while, right? There's a lot of uncertainty in the stock market. I personally like things backed by real estate or real assets. Businesses can be good too, although businesses you have to be careful, but there are some good, solid businesses you can make money in. There are so many ways you can invest in real Main Street investing versus Wall Street investing. You can do so much better and you get good income. Instead of having $1 million that you're saying, well, I want to retire at 62, I've got $1 million, I better only pull out $30,000 a year. You can do like what Dan Markert did when he was on our podcast twice, right? And he said he took that money. He's like, cool. And I took my $1 million and turned it to 13 grand a month, right? Depending on the day. I know with oil prices that it could go up or down a little bit. So that's why I usually tell people he went from trying to pull out 30,000 a year, according to his financial advisor said, to over 100,000 a year, right? Even though 13,000 a month is a lot more than 100,000. But I was being conservative based on that. So anyways, I mean, he was, again, doing different things with oil and gas and rental properties, and also even things with like, apartment syndications and things like that. So there's all kinds of ways and means that you can make money outside of Wall Street that actually have real assets backing up that don't go up or down on a daily basis. So you don't have all this freaking craziness going on, this like bipolar nature, right? Like it's not like that at all. And so there's way better ways to do it. But again, it's always about that income. Is how do you turn that cash into income? Instead of having savings sitting there and you're trying to hope it stretches out long enough just to last you till you're dead. No, we take that savings, we take that net worth that we talked about, what could be worthless, and turn it into real passive income. So remember, 4% rule debunked so long ago. It's dead. And there's still people holding on to it, including the guy that created the 4% guideline, as he would call it. But people started calling it the 4% rule. Even he's like, no, 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 it wasn't supposed to be like that. Of course, he's supporting it because that was his idea, right? But if you start to look at people that are really objective about this, they're going to say, no, that 4% rule doesn't work unless you're 70 plus years old. It's 3%, or if you're trying to retire young, 2%. Hey, the thing is, if you want to play that game, fine. But let's just hope and pray you don't have the market take away that money, and all of a sudden you have to work an extra 10 years to make up for those market losses. Instead, do something that's been proven to work, not just for myself, but for many others. You could do that. In fact, maybe, especially if you've been such a good saver, you might be able to do it by the year 2030, which is exactly what we're trying to get 1,000 people to become financially independent, where they are work optional. They work because they want to, not because they have to by 2030. That could be you. If you're wondering, just go try the passive income calculator on our website, moneyripples.com, just to see what number you get. It might surprise you. So, guys, make it a wonderful, prosperous week. We'll see you.